All right, so you're ready to jump headfirst into Forex trading, right? Eyeing those currency pairs, picturing those gains. But before you go all in, are you considering the tax man?
It's like building a house, you know? You gotta lay the foundation first. Can't just slap on a roof and hope for the best. And in Forex, that foundation is understanding your tax obligations.
Exactly, and that's what we're diving into today with this skilling article. They're a global CFD broker. For anyone new to this, that basically means they let you trade on price movements of things like currencies without actually owning the asset itself.
Yeah, they give you the platform, the tools, and yep, they're a big part of this whole tax situation.
And what's great about this article, at least from what I've seen, is that it doesn't drown you in jargon. It's actually, dare I say, easy to understand.
Definitely. Whether you've been trading for years or just starting to research, it's a good breakdown.
Because let's be real, Forex trading can get complicated even before you think about taxes. So let's unpack some key things, starting with capital gains taxes.
Basically, when you make a profit, that profit is typically taxed as capital gains. It's like if you buy low, sell high on a stock. Same principle, gotta pay taxes on that profit.
Okay, makes sense, but I'm guessing it's not always that simple, right? What else is there?
Well, the rates you'll pay can be all over the place. Depends on your home country. First of all, they've all got their own laws. Then how much you actually profited, because more money sometimes means higher tax bracket. And lastly, how long you held those trades, short-term versus long-term, changes things too.
So many factors. It seems like being organized is super important here. Which reminds me, the article really stressed keeping detailed records.
Oh, absolutely. Can't emphasize that enough. Not just for tax season either, but think about it. Those records. Gold mine for improving how you trade. You see the wins, the losses, when you traded, what currencies. It's all valuable for future
It's
decisions.
like a trading journal, but with potential tax
Yeah.
benefits. Two birds, one stone. But let's say you're trading internationally. Does that change the tax situation?
Yeah, trading internationally. That's where things can get a bit hairy, tax-wise.
Harry, how? More paperwork, I'm guessing?
Think about it. We talked about your home country's tax laws, right? But now you're adding another country to the mix, the one where your broker is.
Two sets of rules, oh boy. Does that mean you get taxed twice on the same profits?
That's the risk. Yeah, it's called double taxation. Say you live in, I don't know, Germany, trading through a broker in Australia, and you make a nice profit. Both countries could want a piece of that.
Yikes, that's rough. So how do you avoid that? Asking for a friend.
Don't worry, it's not a complete free-for-all. This is where tax treaties come in.
Tax treaties. Sounds complicated.
They're basically agreements between countries, figuring out who gets to tax what so you don't get hit twice. Your home country might have a treaty with the broker's country specifically about Forex trading profits.
So, like finding loopholes, but official.
More like clearly defined rules. It's important to know them, though. That's why you've got to do your homework. The laws in both countries, if a treaty exists, what it says, it's all important, really specific to your situation.
Okay, starting to get a bit overwhelming. We know the what now, capital gains, international stuff. But how do you actually calculate these taxes? It can't be as easy as they make it sound, right?
It definitely can seem complicated. This article actually lays out the steps pretty well, though, breaks it down.
Walk me through it then. What are the main things people need to know?
First things first, you got to figure out your tax residency. Sounds simple, but especially if you're, traveling a lot, living in different places, which country actually considers you a resident for tax purposes? That's important.
Okay, so know where you stand tax-wise. Got it. What's next?
Once that's settled, got to calculate your taxable income, take your Forex profits, subtract any expenses you can write off. That's what you're taxed on.
Expenses. So it's not just about the profit, but what you can deduct too.
Exactly. Those broker fees add up, maybe some software you use, educational resources. Those can often be deducted, which can make a difference in how much you owe at the end.
Every bit helps, right?
hmm
Okay, so we've got residency, expenses, anything else that could change the final amount.
Oh, yeah, especially for international traders. You got to factor in currency exchange rates. Say you're in, let's say, Canada, trading in US dollars. The exchange rate between those two currencies when you actually cash out your profit, that matters a lot for your taxes.
So those fluctuating rates aren't just messing with you during the trades themselves, they come back to haunt you or help you later on.
Exactly. And again, having good records is super helpful here. Imagine trying to remember all those exchange rates at specific times if you haven't been keeping track.
Talk about a nightmare. Spreadsheet lovers, this is your time to shine. Okay, so we've covered keeping organized, the whole international trading thing. even some deductions. But this article goes beyond just Forex, right?
It does mention other markets briefly, like commodities, even crypto.
It's like a little glimpse into this whole universe of trading opportunities.
A universe with some potentially scary tax implications if you're not careful.
Exactly, and that's the point, right? Whether you're into Forex or oil futures or Bitcoin, you have to understand the tax rules before jumping in because they're not all the same.
No one-size-fits-all approach here.
Right.
Got to tailor your strategy, including the tax part, for each market. For sure. And never, ever underestimate getting some expert help. There's info online, yeah, but when it comes to international tax laws, and they change all the time, a good advisor is worth every penny. They can help you optimize everything, give you peace of mind.
Consider it an investment in your trading success, like you said. So if our listeners are only remembering a few things from this deep dive, what should those be?
Number one, stop thinking of taxes as something you do after trading. Make it part of your whole plan from the start. Just like you research trades, you got to research taxes.
Don't let those forms catch you by surprise.
Yeah.
What else? What else is crucial?
This can't be stressed enough. Keep good records. I know it's boring. But future you will send you a thank you note, a good spreadsheet, a trading journal. Lifesaver come tax season. Calculating gains and losses, all those exchange rates, even spotting patterns in your trading, it all ties back to having those records.
Organized trader equals a less stressed trader. It's true.
And lastly, seriously, don't hesitate to get help. If those Forex taxes, especially internationally, are making your head spin, find a tax advisor who specializes in this stuff. Best decision you'll make.
Work smarter, not harder, right? Now, one final thought before we wrap up. This whole thing got me thinking. Forex is constantly changing, and the tax laws are right there with it. New rules, new agreements between countries. It's a lot to keep up with. So here's a question for everyone listening. How often should you be checking those tax laws to make sure you're still in the clear? Something to ponder.
Great question. Really gets you thinking. Maybe that'll be our next deep dive.
Could be. But for today, big thanks to Skilling for the informative article. Listeners, head over to their website. They've got tons of resources and tools for Forex trading.
They do. And remember, knowledge is power in the trading world. So stay informed and happy trading, everyone.